Welcome to the daily update, where I'll go over the action in the market for Tuesday, January 7th, and we'll see how things look for Wednesday, January 8th. Okay, well, the gains that we saw on Monday, at least on a price basis, were given up on Tuesday. We're back down below the 50 period moving averages now, so that's turned the intermediate term back to negative. We never switched over positive with the short term. And so, yeah, the market is really lacking any kind of conviction to really carry things in a trending manner. Now, some of our indicators are starting to switch back more negative. Some of them are holding up a bit better. And the mega caps, which did good on Monday, didn't do so good on Tuesday. And it's really about rising interest rates. The 10-year yield just keeps going up. And the economic reports that came out were stronger than expected. The bond market went up with yields, and that is pressuring stocks. Okay, so let's go back and talk about what happened. We did have a higher open. Initially, it looked like, okay, maybe we were going to get a little bit of follow through to Monday's advance. And prices then went up, but we hit resistance right at 6,000. Then everything turned. We went down below the daily pivot at 59.85. Then we went negative by falling below the unchanged level, fell down below S1 at 59.50. We finally found support down at S2 at 59.24. Then we tried to bounce back up off of that and regain S1, but we ended up declining down below S2. We found support at a round number at 5,900, and we stayed right around that level going into the close. We were down 1.11% on barely above average volume. Now, one thing that could be encouraging, the update that we saw on Monday that was on above average volume, we were above average on Tuesday, but it dropped off from Monday's level. So that's a little bit of a positive thing in the background. We are negative in the short and intermediate term. We continue to be positive in the long term, and it's about interest rates right now, as I explained. And then we just keep an eye on the different geopolitical things going on. Okay, we are back down below the 50 period simple moving average, which is right around 59.50 after we had regained it on Monday. Interest rates are still going up because of the strong economic data that's coming out, and that helped the mega caps to underperform. We still have a confirmed Hindenburg Ullman that we're keeping an eye on, and really the only thing on our list now, and even this is improving because momentum is starting to shift a little more positive, is the slope oscillator. It's still looking extreme negative. We have nothing else right now. That's how choppy the market has been. And no changes to the scenario involving the Fed. We're going to get the FOMC meeting minutes in Wednesday's session. So maybe that will be something that will give the market to key off of. There was some dissension when they came out with that last interest rate cut. The dollar was up, which is pressuring stocks, and interest rates were also up. We're at 4.68% with the 10-year yield, where we had been at 4.61%. We ticked down just a notch with sentiment. We're at 36 now, where we had been at 37 after Monday. And we're back to kind of dropping below the moving average with our ADX. We're in a negative trend. That didn't change after Monday's advance. The red line is still above the green line. We're dropping below the moving average, which is kind of getting picked up by the ADX, suggesting we're just chopping right now. But we're still above 20. So we are in a trending environment. The down day, so the bias is negative and the momentum. I had it at mixed to positive because of the down day. Now it's more mixed to negative. All right, we did get the trade balance, which came in up from the last time that we saw this at a minus 78.2 billion, more than the 77.9 billion they had expected, also up from the 73.6 billion that we saw last time. This was the big one. ISM services came in strong, but stronger than expected, and that spooked the markets at 54.1. That's above that 50 level, so it's showing expansion with the services or non-manufacturing. They expected it to come in at 53, and last time it was at 52.1. The JOLTS job openings also going up. The employment situation seems to be holding up for right now. We're going to get the employment situation report on Friday, but the job openings came in at 8.098 million, up from the 7.839 million that came out last time. So here's a chart. This is the trade balance, which is actually going down here with the 3 month average overall, but actually, I should say it's going up because these numbers are getting more negative as we go down. And then the nominal exports and imports year over year, they're both going up right now and both are above zero. And the deficit going a little bit lower than what we saw last time, but not as bad as what we saw before that. And then the ISM going up with the blue line, and we're above 50. That's showing expansion and prices. This is the part that spooked the markets. To see this yellow line really going up, it's like, uh-oh, this could be inflationary. We better lower bond prices and have interest rates go up. And then the job openings also are increasing. So this part is looking solid. And Isabel Net, this is a chart we look at once a week or so. The overbought, oversold composite coming in at 64 right now. So we're not extreme and we're not really drifting down into a negative stance, at least based on this chart. Now we are with the sentiment gauges that I follow on a daily basis. This weekly chart is a little more subdued. And maybe the US isn't as top heavy as they tell us, that we just take into account here 38.8%. That's the dark blue area. It's the weight of the top 10 holdings in each country. And there's other countries that have a lot more that way. We talk about the Magnificent Seven or the Big Ten stocks, Illustrious 11, whatever you want to call it. And we're not necessarily out of line with what's going on in other countries. This is kind of a convoluted chart. Basically, the takeaway is when we have a greater than 10% return in the year before, which we did, we were up over 20%. And the first 5 days of January, the performance, well, this chart was after a Monday, so naturally they're going to come out with some positive looking things. It just means that things tend to look good going forward. Well, try to tell that to Tuesday. And then this is something that I do go over in the intermarket analysis video over the weekend. This deals with the Robert Shiller version of the PE ratio called CAPE. And it's just suggesting that we are overvalued, but we've been seeing that for a long time. And then the performance during rate cut cycles, we've showed this chart before. Basically, there's a couple of different contexts that we look at. If the Fed is coming in and cutting rates to try to stimulate the economy, that can help stocks. And that's what's been happening, at least up to this point. Although when the Fed started cutting rates, that's when interest rates started to go up because the bond market is more concerned about economic growth and inflation. But if they come in and they cut rates for a bad reason, like some catastrophic event, that tends to be more negative for things as well. And that's kind of the scenario we've been working with is we're dealing with the first scenario that the Fed is not necessarily seeing anything catastrophic on the horizon, so they're trying to do what they can for the economy. All right, weekly flows into crypto. Even though we got back up over 100,000, we're back under that now. We're seeing a lot of money coming out. It's like once they get over 100K on that thing, people just start dumping it like crazy. I follow it, but not that close, so I don't have a real in-depth analysis take on that. And the economic surprise index, now this was after Monday and it's starting to go back up. Now this will probably continue to go up after the economic reports that came out on Tuesday. And that can often put pressure on the market when the economic reports come out stronger than expected. And then this is the equity returns in 2024 with communication doing the best and tech and discretionary. And as I point out over and over, these are the three main growth areas. And when they do well, the stock market does well. And the copper to gold ratio, I also go over this in the intermarket analysis video on the weekend. We're just seeing a massive divergence between the two here, where the interest rates are going up and the copper to gold ratio is really going down, where they tend to go in the same direction and they tend to not get all that further apart from each other. And even though it's been happening now for the last few years, pretty much since the COVID crash, and we're wondering, okay, what's this telling us? We're not quite sure right now. Interest rates are going up because of inflationary concerns, and the copper to gold ratio, that when that's going down, that means gold is outperforming. And gold is usually a protection against inflation as well. But we'll have to see how this continues to work itself out. And then the probability of a recession in the next year, now that could change at any time, but it's very low right now, anywhere from 20% down to 15%. I did find a few interesting charts here. These are sector correlations, and really the takeaway is more in the text at the top up here. It says the correlations suggest the bull market that started in late 2022 is alive and well. Okay, based on the current reading. Current readings are close to average and therefore point to reasonable rather than excessive investor confidence, according to this. Okay. Then the past 5 years of returns, there have been no normal or average years to speak of in this decade, going back to 2020. Every year has experienced wide swings, higher or lower, and sometimes one of each. Where, like 2020, we were up 18%, but at one point with the COVID crash, we were down 33.9%. 2021, we were down 5.2% at the low point, but we ended up getting 28.5%. 2022 was the difficult year, down 18%, where we had been down over 25%. That kind of lined up with each other. And even in 2023, we had some difficult times, down 10.3%, but we ended up getting 26.1% according to this. And in 2024, we were up 25%, with the drawdown being minus 8.5%. So that's why when you work with averages and what usually happens, they don't line up with what really happens here. All right, American exceptionalism isn't exceptional, it's just showing how U.S. companies are really outperforming and never have really lagged what's going on in the rest of the world. And we want to keep an eye on this. This is the 10-year yield for the bond in Japan. I'm sorry, in China. I have another one for Japan here in a moment. But see how their rates are just falling off a cliff here. They're having some real economic problems in China. And I point that out because of S&P 500 companies that do business with China. And so that can have an impact. If their economy is slowing down, that could hurt some US companies. And then 151 years of S&P 500 returns, more in the middle area here. And we don't know, of course, what's going to happen in 2025. But this is just showing real solid growth over the long period. And how you can look at something like this and be a perma bear is beyond me, because this just continues to prove people wrong along the way. And this is the Japanese 10-year bond. It's starting to go back up again here. Now, if you remember back in August when this really started to go back up, and that freaked out this whole thing where the VIX was really going up, and people that don't even know how to spell the VIX were talking about it, let alone understanding it. And we had that big down day. It was August 5th, and that lasted a couple of days. That was triggered by a rise in Japanese interest rates. And so we're keeping an eye on this just to see if that produces some kind of another event like what we saw last summer. Okay, here's intraday chart. Look, it was looking pretty positive. Now, one thing I noticed from this chart is that if you go to the high that was set on Monday and the close that was set on Tuesday, you see how this is more of a continuation if you take out the positive open. And we did try to have a higher open. We were above the daily pivot, and we immediately set the high right at the open at 6,000. That was it. That was the high price for the day. Tried to set up a base here at the daily pivot. Then we had the ISM services report come out, and market didn't like that. Interest rates started to go back up. We shot down to S1, even broke all the way down to S2, tried to bounce back up, trailed along S1 for a while, came back down to S2 again, didn't really mount any kind of a meaningful rebound here, and then came back down to S2 again, and then we broke through it. And we finally found some support at the 5,900 level and then bounced a little bit going into the close. All right, so We're up about a quarter of a percent. I checked the futures right before I started recording, but this is many, many hours before the market opens. But we were looking pretty good here and before the market opened, and really the futures were strong. We had a solid open, and then everything fell apart during the cash session. But we're still looking okay here. Now the blue line's coming down, but it's above the red line. So under the surface, growth is still outperforming value intraday and took a bit of a hit here. If you go back to the latter part of November, we've been holding up with our intraday growth to value ratio for the S&P, but growth just got hammered here compared to value, even though both were down. And it was down more for the mid caps and also down more for the small caps. So still looking okay here. The indexes are doing nothing with the small caps, but we came down a little bit with the ratio, although it's still in an uptrend. And the same thing with the mid caps, really going nowhere as far as the index, but there's still this ratio is showing growth outperforming value. Took a bit of a hit here. We are in an uptrend with S&P growth to value. Again, it's not really transferring over into consistent gains for the S&P. And coming back down a little bit with our growth versus value ETF study here. We're just at the top end of the rainbow after having a good day on Monday. And coming down, but still looking pretty good here with discretionary to staples. So we're not seeing these growth to value ratios falling apart, at least yet. They took a hit on Tuesday, but they're still holding up. Large cap growth, which really had a good day on Monday, is still above its 50-day moving average, but it did come down in Tuesday session, not quite 2%. And looking at our trend where we were starting to show a little bit of an improvement here, no, we're actually coming back. We're right on top of the moving average for the most part. And the red line, which had been coming down, is now going back up, and the green line's going down. So this never did switch over positive. It's actually looking a little more negative now, but non-committal because the market's just kind of chopping around right now, and the ADX is not picking up much of a trend. And we're seeing that in the short term too. Maybe just a little bit above its moving average, or you could say on top of it with the red line going back up. And volume did pick up. It was above average, but off of Monday's readings. Sentiment, we're coming down a little bit with the Ulcer Index, but still well above the moving average. Because of the down day, the VIX was up with the line chart as well as the bar chart, but we're still under 20. And the VIX of the VIX is also picking back up above its moving averages, so showing volatility is picking up there. And now, again, and I've had people ask, okay, what does this mean to us? If we're getting this really high reading here in this red area, I just say big move expected. Does that mean an up move or a down move? Yeah. I don't because there are times when it means a top, a bottom, or a continuation, and it seems like okay, on Friday and Monday we had good solid up days and this decline. So maybe a continuation of moving up would help this index actually come down out of the red area. Well, we had a decline on Tuesday, and this still is now coming down. So it's been really difficult to try to interpret this particular chart. And it's why I use additional charts to try to get some context. Excuse me there. Okay, and the momentum for the VIX is really confused right now. It's not sure what it wants to do. And this is another contradiction. We went up with this fear gauge rather significantly, but we're going down with this other fear gauge. And not much of a change here with the risk on to risk off ratio. It was starting to go back up after Monday. It fell back after Tuesday. And we ticked up with the 1-day equity put call ratio, but we're still going down with the 5-day chart. And we're below this red level. We're getting to a kind of an extreme negative reading, which could suggest a market top. Also getting a low reading here, but we could still go lower than where we are at right now. And we're still going down with the 10-day average, which tends to be more positive until we get such a negative reading. Not really seeing a change here, though. In fact, the volatility risk premium continues to drop and it's below the band. So it's not freaking out like, the VIX is going up and the skew index is all over the place. This one's actually rather muted. And Not really seeing any improvement. In fact, a little bit of a deterioration with our advanced decline line based on price and volume. It did tick down, but still above the moving averages. Trying to turn up with our 5 day and leveling off now after turning up with the 10 day, and didn't see much of a difference here. We saw some new highs, but we also saw some new lows being generated. And still below zero with our advanced decline ratio, both 19 and 39 periods, short and intermediate term. Still below zero with the advanced decline ratio based on price and volume. That was looking better, but not as much now. And turning more negative with the accumulation distribution. Going back down with the boom indicator below zero, we're dropping below the moving average. This now is negative. And we never did really turn positive with the Chaikin money flow. We showed a little bit of an improvement, but the red line continues to go down. That's negative. And we're continuing to decline below zero here with the Chaikin oscillator. So now our three smart money indicators are confirming each other as negative. The vortex is also negative. The red line's above the green line. And now this is kind of interesting here. Not really seeing much of a change with our cumulative advanced decline line based on price or volume. And showing a little bit of an improvement here with the 10-day average of the highs minus the lows for the S&P. So that's longer term. And we're going back down with the NYSE advanced decline line as well as with the S&P. But you can see the red lines below the S&P itself. That just means the broader market is underperforming slightly. And let's see, the cumulative advanced decline line for the NYSE is still above the moving average, but we're still below the moving average with our regular NYSE advanced decline line. Also with this other NYSE advanced decline line. See, really choppy right now. No real conviction at this point. This is the one that I thought was kind of interesting. We went down with the cumulative advanced decline line, excuse me, the common stock advanced decline line based on price. We actually went up based on volume. Kind of interesting there. That could be positive and under the surface. But our advanced decline line studies still declining below the moving averages with all the indexes. After going positive and looking better, the 10-day simple moving average of the advanced minus the decliners for the S&P has now dropped down below zero. So that's turned negative again. And this is improving. We're actually turning positive with our 5-day moving average of the highs and lows across the broad market. It's actually going above zero. And this is the one that kind of held up a little bit better with the declines. We were pretty much flat with those stocks above their 20 period moving averages after we had been showing some improvement here and not really seeing any kind of major thrust that produces, confidence because we're not seeing any follow through right now on a short-term basis. We declined a little bit to flat with our 50 period moving average study. We were flat with the 100. We were declining still with the 200. And we're getting close to that 50 level. If we drop below 50, that's going to turn the long-term study negative here. And short term, you can see where volume was a little bit above average, but off of Monday's level. And we've dropped back down below the 50-day moving average now. And not much of a change here with a 20 period exponential moving average. We declined with the 50, slightly declining with the 200. We're back below the midpoint with our short-term oscillators here, the Stochk RSI, the Williams percent R, CCI 14 and 20. Never did get above it with the CCI 20. We're going down with the short-term stochastic below the midpoint, still going up in the intermediate term, and we're still declining in the long term. See, these indicators are really mixed up right now. And after being positive with the force index, now we're dropping back down and looking negative. And we were looking a little better with the condition of our short-term trend. We'd gotten above the blue line and the green line. Now we've fallen back below them again. And we're below the 20 period simple and exponential moving averages. Now, we never got above the simple moving average based on the closing price, and we just have fallen back down below that here. We were above the midpoint with our standard deviations chart. Now we're back down below the midpoint in the -1 channel. And we were flat with the balance of power. After Monday, we got a reading of zero. Now we're going back down. And you can see this looks like a rainbow here. The go, no go. Usually the colors stay the same for an extended period of time. And when they jumble up and start changing color, well, that means the market is really mixed up right now. dropping below the midpoint with our highest high, lowest low value chart. But the TTM squeeze is still the lighter shade of red and still going up slightly. And coming back down with the standard deviations chart as we're just kind of bouncing around with the S&P right now. Still negative with the ease of movement, and the rune didn't change, and it's negative. Coming down below zero with the S&P McClellan oscillator after it had been showing signs of improving. But when this is below zero, that means the summation index based on price is going down, but we're still seeing it based on volume going up. So that's a bit of a potentially positive divergence there when we see volume leading price, but volume is really slowing down to the upside. We were positive with the NYSE McClellan oscillator. We got above zero. Now we're back below zero. So after it looked like we were ticking up, the summation index based on price, they still look like they're ticking up here, but really they should be declining now since we're below zero. And this is encouraging though. The Swenlin trending oscillator based on price and volume are still going up. Now they're negative, but to have the down day that we saw and to have these continue to go up could be positive. Momentum was trying to improve, and now it's looking not so good here with the PMO, but we're still trying to turn up based on price and volume, but both are still below their moving averages. This is encouraging too. Now, no real change with the PMOs that are rising. That actually came down. But the buy signals are continuing to go up after being extreme negative. That's kind of encouraging. And we're slowing down, at least for right now, with those PMOs that are above zero. This is improving, but we're still below this red line. That's why it's the only one on our list that's extreme negative. But we're trying to come back up to the moving average with the slope oscillator, but the MACD is still negative. So the slope in the short term is looking better. We still have a ways to go with the TSI. We're trying to turn up in the intermediate term, but we continue to be negative with the long-term oscillators. And turning up here with the copy curve, but still below the moving average. So it remains negative. After coming up into the green area, we're now back down into the more neutral area with the Sean trend meter. We crossed back above 50. Now we're below 50 with the money flow, and we're below 50 and declining with the ultimate oscillator. Still above the moving average, but coming down with unbalanced volume. We were starting to climb back above 50 with the RSI 14 and 9. Now they're going back below 50. And we've gone from positive to negative with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. We're still below the blue line and the red line with the condition of the intermediate term trend. And we recaptured the 50-period moving averages. And now we're back below both of them. So we're below the 20 and the 50. So that's turning our short and intermediate term outlook to negative. And we're still looking okay here with the bullish percent index. Now it came down, but it's still above the moving average, and it had a really nice upthrust in Monday's session. And just kind of chopping around below 50 with the NYSE bullish percent index, still above 50 with the NASDAQ 100 BPI here, but it did tick down a bit. And we hit this upper end. This is the simple moving average based on 20 periods of the high. That was the high that we set, and now we're falling down below this little mini rainbow, coming back down into the cloud now, and the blue line's still below the red line, and the green line is now going down here, and still looking at this longer term trend channel where we hit this higher level and we've not been able to get back above that. So looking at kind of a doji look here with the Heiken Ashi, where we have the open and close just about at the same point. We're negative and pointing down with the Kegi chart. We're negative with the Renko chart, and we're negative with the three-line break. So the positive things that could have been building just didn't see any follow through on Tuesday and then started to show weakness again. And coming back down with our 150 and 200 period moving averages. Here, no signal has been generated with this wagon NYSE breadth thrust. We're just keeping an eye on that for right now. Negative in the short term across all stock indexes. We're still negative with the mid caps and the small caps in the intermediate term. And bonds are negative across the board on all time frames. Commodities have switched back over to positive in the short and intermediate term. Of course, stocks are negative in the short term, and the dollar is still pretty solid on all time frames there. And the two areas that were up as far as our sectors were energy and healthcare, which tend to be more defensive, especially healthcare. the jury's kind of out about energy. It could be a growth area because of all of this, electric vehicles and the increased need for electricity and those kinds of things. But tech, discretionary, and communication, these are the three big growth areas. They were down the most. And so we're seeing a lot of blue and or green and red here, which started out pretty good. Canada had a bullish MACD crossover. Materials, they had a 5,200 crossover negative, and discretionary had a BPI cross below 50. Let's see, the rest of these are just levels where we got to 19.9 with the NASDAQ, then 19.8, 7, 6, 5, blast off. And then the S&P did, it crossed below 5,900, but that level ended up holding on a closing basis. We're still seeing weakness overall when we compare the equal weight with the weighted version of the S&P. And so our ratio is coming back down here, but not showing any real conviction after it had really been going up. The Dow just floundering around, going sideways below its 50-day moving average, neutral with the Elder's Impulse system. And the NASDAQ, which had been holding up better, it came down and actually closed a little bit below this pivot point, but it's still above its 50-day moving average. Also coming down to the 50-day moving average with the NASDAQ 100. And we've gone from positive to negative now with the Elder's Impulse system for the Qs. The momentum for the NASDAQ 100 continues to be negative. We lost the 20-period moving average with the Qs, but we're still above the 50-period moving average. Small caps just chop around like crazy. Are they going to build this base here and drop to the downside or eventually break to the upside? Really not performing as the market had anticipated. And here's the small caps as measured by the Russell 2000. Still below 50 with the RSI, below the 50-day moving average. Seeing some improvement here with momentum, but we haven't crossed over positive there. Still neutral with the Elder's Impulse system for the mid caps. Small caps continue to bounce sideways, and they're still neutral with the Elder's Impulse system. We had recaptured the 50-day moving average with the Wilshire, and we lost that on Tuesday. Also, the same thing with the total U.S. stock ETF. Now we're below the 50-day moving average. So the financial sector was down 0.25%, but still hanging out, but below its 50-day moving average, but it's in a longer-term uptrend. The FANG index holding up a bit better. It was down over 2%, but it hasn't even come down to its 50-day moving average. And we're right in between this short-term trend line and this longer-term trend line. Apple was down over 1%, still above its 50-day moving average. Amazon was down 2.42%. Microsoft down 1.28%, coming down to its 200-day moving average. Google was down 0.7%. It held up a bit better. Meta was down 1.95%, still above its 50-day moving average. Tesla really had shot up nicely, but it lost over 4% on Tuesday. Nvidia, which started off the day really good, didn't end so well. It's coming back down to its 50-day moving average. And Netflix also coming back down close to its 50-day moving average. When you see a lot of minus signs here, that's why the indexes go down. And this area of support that I was watching for staples, which again, this is a defensive area, but the idea was that maybe we would bounce up off of that and that might give the market some support. We're continuing to fall below the 200-day moving average. And the semiconductors, though, they were down again, but was this a fake out or is this some kind of a real breakout here with the SMH semiconductor ETF? It's coming down. We've been to this spot before, and this is when semiconductors started to run into trouble. And we look at the SOX index, which had been able to get above its 200-day moving average. Now it's back below. And the ratio actually continues to go up because even though the semis didn't have a good day, tech had a worse day. So that could actually be a little bit positive there. And the Dow Jones Semiconductor Index fell over 4%, but still above its 50-day moving average. Wondering if this is producing a breakout here. It looked like it, but not right now. We'll have to turn and go back up and see some improvement there. This is the other area of support that I've been watching. This is the total bond ETF, and we're dropping a little further below the 200-day moving average, and that's why interest rates are going up. And let's see, not really seeing much of a change here with the short-term correlation between US stocks and world stocks, but the longer-term correlation continues to improve. Oil is still going up. We're getting into the 74 range now, just keeping an eye on that one. The dollar is still looking really solid, back well up into the 108 range again. And we're going up with the 10-year yield, and we're going down with the 10-year based on price. And that's kind of the story right now. This is still showing more weakness when we look at the ratio between home construction and 3 to 7 year bonds. Not holding up, not improving now. So taking a bit of a hit when we look at the Qs to S&P, falling below the moving average now with discretionary to S&P, coming back down to the moving average with large cap growth versus large cap value. So the large caps back down to the moving average with the mid caps, a little bit above the moving average with the small caps. So what's our outlook for Wednesday? The markets will be closed on Thursday for the state funeral for President Carter. So just be aware of that. We're back to being short term and intermediate term negative, and the improvements that we were seeing after Monday seem to be going away now. But there's still some things holding together too. It's not like everything's necessarily falling apart, but it's certainly not turning positive. We're going to get the MBA mortgage applications index, the ADP employment change, more employment data, and then the FOMC meeting minutes at 2 p.m. Eastern time. Consumer credit will also be coming out, and then all the geopolitical things. And as I've been trying to point out here, on Thursday, there will be people from all over the world, a lot of important folks from around different countries that'll be coming into the US. You've got a congregation of a lot of people in the same place at the same time. And that's a security nightmare. Let's just hope nothing crazy happens that way. All right, and I don't know where we're gonna come out here because we're gonna be closed on Thursday, so we'll have to see how things play out. And then on Friday, we're gonna get the employment situation report and consumer sentiment. So Wednesday, this is kind of a big deal here and unsure about Thursday with big things happening on Friday. Seasonality with on January 8th, we are neutral to positive with the Dow, where we're positive with the S&P and Nasdaq. So at least that's going back over the last 21 years or so. But when you look at this chart, we still have some negative seasonality to deal with here. And this is longer term, not just over the last 21 years necessarily. And this is the post-election type of way of calculating this. And Wednesday is it's better than Tuesday as far as how it acted in 2024, but not one of the best performing days. We're still in the first half of January, which tends to perform well. Tell that to Tuesday. And small caps, which should be beyond the moon by now and on their way to Mars, not just going nowhere. And here, I'll probably drop this out of the video here pretty quick. This is longer term. We're only up 58% of the time in January with the S&P with a return of 1.1%. And I won't go through this. I've been showing it for a while. This is just the different ways of measuring seasonality. We're way over here on the left-hand side with this jumbled spaghetti mess, so it's kind of hard to pick anything out. And the first quarter can often be weak when you have the new presidential cycle starting, and we're in the negative time now, according to Tom Bowley's research. All right, so the warning signs. I shouldn't say mixed. We're actually more negative over here. When we look at our three smart money indicators, the advanced decline line's just not doing well right now. Both the S&P and NYSE McClellan oscillators and summation indexes are negative again. They were split after Monday. The parabolic SAR, the Swenlin trading oscillator, the oscillators that we look at, those are all negative with the confirmed Hindenburg-Ullman. The vortex, our moving average studies, ease of movement, money flow, and ultimate oscillator, those are all negative again. And the momentum for the NASDAQ 100 is negative. Positive signs, we're still seeing more growth to value and discretionary to staples. They're holding up for right now. And we're still going down with the 5 and 10-day equity put call ratios. That tends to be positive, but we're getting extreme with our 5-day chart. And The bullish percent indexes are positive, but they showed some weakness in Tuesday's session, especially for the S&P. That's the one that I'm focusing on the most. And we're still above 50 with our 200 period moving average study. But we need to watch that. We're like 53. So if we fall below 50, that could suggest things are turning more negative longer term. And the financial sector, even though it's below its 50-day moving average, it's still positive. And here's an update of the chart showing now that we have a spike down. All right, our conclusion. We're losing the improvements that we were starting to see both in Friday and Monday's session, but we still have the large caps and growth that are hanging in there. We're back to negative in the short term, and we're back not only below the 20 period moving average, we're back below the 50 period moving averages. Intermediate term, we're negative because we're below those 50 period moving averages, but we're still positive in the long term. Thank you. Have a really good day, and I will talk to you in the next video.